Ever wondered what the current market outlook is? Well, Michael Pento, a renowned economist, provides an interesting perspective. Pento is currently bullish in the short term due to his investment model. However, he is simultaneously the most concerned he's ever been about long-term market risks. He believes the market could potentially correct by over 50% to return to historical valuation metrics. Pento has key economic concerns. For starters, he's worried about the unprecedented debt levels. Total non-financial debt is now a whopping 260% of GDP, a stark contrast to the 132% during the Reagan era. Business debt has more than doubled since the 2008 financial crisis, and national debt to GDP is now 123% compared to 31% under Reagan. Pento also highlights market valuation risks. The total market cap of equities to GDP is at 207%, a far cry from the 40% under Reagan. The price-to-sales ratio for S&P 500 is close to 3, which is an unprecedented figure. Economic indicators also worry Pento. The yield curve is the most inverted since 1981. Leading economic indicators suggest a weak economy, and the copper-to-gold ratio indicates economic uncertainty. There's a shrinking labor force participation rate as well. Pento draws comparisons to the Reagan era, pointing out that unlike Reagan's time, current economic conditions do not provide the same tailwinds. Inflation is not drastically declining. Labor force growth is minimal compared to the 1980s, and there's less room for government economic stimulus. However, short-term optimism is driven by anticipation of potential Trump policies such as tax cuts, deregulation, and potential tariffs and deportation policies. Pento is critical of current economic narratives, particularly those suggesting inflation is under control. He argues that the overall price level remains high, causing significant strain for most Americans. His economic model currently identifies the economy as being in sector 4 inches, reflation, with potential risks of moving back to disinflation and then deflation. He believes the top 20% of earners have been keeping the economy afloat, but signs of weakness are emerging, even in luxury markets. The American consumer, particularly those in the bottom 4 quintiles, is struggling with high prices across essential goods like food, insurance, and housing. Pento anticipates a potential tsunami of home sales as investors look to offload properties, which could further destabilize the real estate market. He warns about significant market concentration, particularly driven by passive index investing and AI-driven investment strategies. In terms of portfolio strategy, Pento is currently invested in uranium miners, India-related investments, S&P 500 momentum ETFs, quality growth stocks, and an inflation-hedged index. He recently sold gold and silver, believing they're not optimal in the current economic sector. Pento expects the Federal Reserve to eventually respond to economic challenges with massive liquidity injection. He predicts the Fed's balance sheet could expand to over $9 trillion, potentially leading to prolonged stagflation. He warns that many investors in target date funds and passive index investments could be vulnerable to a significant market correction. Pento's advice: be an active investor. Don't rely on passive set-it-and-forget-it strategies. Be prepared for potential significant market corrections. Have a robust investment model. Be prepared for potential market volatility. Understand the risks of concentrated market investments. In a nutshell, Pento's message is one of cautious optimism in the very short term, but deep concern about long-term economic sustainability and market valuations. A fascinating perspective indeed.